878,000 American homeowners are currently severely delinquent or in foreclosure as of early 2026, the highest level since June 2018, with specific loan types and geographic markets showing distress patterns requiring careful analysis of underlying causes beyond headline delinquency rates. Intercontinental Exchange data shows approximately 878,000 American homeowners are either severely delinquent or in foreclosure, the highest level since June 2018. Overall delinquency rates stand at 3.68%, which remains historically low compared to financial crisis levels. However, examining delinquency rates by loan type reveals significant variation. FHA delinquencies reached 11.52% according to Mortgage Bankers Association data, the highest level since 2011. This represents a 106 basis point increase in a single quarter, indicating rapid deterioration in this specific segment. The FHA data deserves particular attention because of what it represents. FHA loans serve primarily first-time buyers, lower-income borrowers, and those with smaller down payments. When this segment experiences elevated distress, it indicates financial pressure on the most economically vulnerable homeowners. Intercontinental Exchange data shows FHA loans account for over 80% of recent increases in severely past due mortgages. FHA loans represent less than 15% of all active mortgages but account for 38% of active foreclosures. The cure rate, meaning borrowers who become current again after falling behind, has declined approximately 70% since last fall for FHA borrowers. These patterns matter because they echo historical sequences. In the 2008 financial crisis, FHA and VA delinquencies rose 6 to 9 quarters before conventional loan delinquencies followed. The current gap between FHA delinquencies at 11.52% and conventional at 2.89% is among the widest in modern mortgage history. This divergence indicates distress concentrated in specific borrower segments, rather than broad-based market failure. Another factor affecting some borrowers is adjustable rate mortgage resets. Borrowers who took ARMs in 2015 or 2016 with 10-year fixed periods are now experiencing rate adjustments. These loans are adjusting from rates around 3% to 7 or 8%, depending on loan structure and rate caps. On a $400,000 mortgage, this represents approximately $1,000 monthly payment increase. Mortgage Bankers Association data indicates hundreds of thousands of ARM borrowers have passed initial fixed-rate periods and are adjusting into higher-rate environments. Additionally, ARM originations reached 12.9% of mortgage applications, the highest level since 2008, suggesting some borrowers are using ARMs not by preference, but as the only way to qualify for financing. Geographic patterns show concentration of distress in specific markets. Lakeland, Florida shows the highest foreclosure rate among metros over 200,000 population at 1 in 409 housing units. Punta Gorda, Florida shows 1 in 416. Cape Coral has the second highest foreclosure rate nationally. These markets also show elevated underwater rates where homeowners owe more than property values. Lakeland shows 10.8% of mortgaged homes underwater. Cape Coral shows 10.1%. Austin, Texas shows 9.2% underwater. The homebuilder situation adds context to these geographic patterns. Wall Street Journal reporting indicated more than 1 in 4 FHA loans originated by LAR Mortgage between 2022 and 2024 is underwater. In Cape Coral specifically, over 1/3 of 2023 and 2024 vintage loans are underwater. American Enterprise Institute research found 64% of homes sold by America's largest homebuilders included permanent mortgage rate buydowns. These transactions made monthly payments appear affordable but potentially inflated sale prices. Buyers who purchased using these structures in 2022 through 2024 in Sunbelt metros using FHA financing may find themselves in challenging equity positions. The institutional investor behavior provides additional market context. Blackstone has reduced single-family home purchases by over 90% since 2022. Invitation Homes bought 0 homes from MLS in fourth quarter 2025. With all acquisitions coming directly from builders, their 2026 guidance calls for $550 million in planned home sales. American Homes for Rent sold over 1,800 homes to individual homeowners last year and guides to another $400 to $600 million in sales this year. Parcel Labs data shows institutional investors in Atlanta selling roughly 2 homes for every one purchased. In Dallas, institutional investors own approximately 9% of housing stock but represent 23% of new for sale listings. 6 specific metros are absorbing most institutional selling: Atlanta, Phoenix, Dallas, Houston, Tampa, and Charlotte. Inventory numbers in these markets show significant year-over-year increases. Charlotte up 38%, Dallas up nearly 38%, Atlanta up 34%, Phoenix up 27%. This represents institutional investors repositioning portfolios based on risk-adjusted return calculations favoring cash over continued real estate holdings in current conditions. Now let's discuss the insurance factor, which represents a critical component of total housing costs. Intercontinental Exchange data shows homeowners in the top fifth of insurance costs nationally show past due rates of 7.6%, compared to 2.9% for homeowners in the bottom fifth of insurance costs. This indicates insurance costs substantially affect default risk. Insurance premiums increased 46% since 2021, 3 times general inflation pace. National average is approaching $3,000 annually for the first time. In 2025, Colorado homeowners saw premium increases of 33%. Iowa, Nebraska, and Minnesota all exceeded 25% annual increases. California presents unique challenges. The state's FAIR Plan, insurer of last resort, now covers over 668,000 homeowners and requested a 35.8% rate increase, the largest in 7 years. Palisades and Eaton wildfires generated an estimated $4 billion in FAIR Plan losses. Some California homeowners could see premium increases of 300% or more this year. Florida condo owners face additional pressures. After Surfside collapse, the state passed milestone inspection and structural integrity reserve study mandates. While well-intentioned, these requirements created substantial financial burdens for some buildings. Mediterranean Village in Aventura assessed individual units up to $400,000 each. Palm Bay Yacht Club in Miami assessed up to $175,000 per unit. When insurance costs double over 5 years, special assessments reach 6 figures, and property taxes increase. Total housing costs can exceed household capacity even for borrowers who have paid mortgages reliably for years. This represents the actual mechanism driving defaults in many cases, not reckless borrowing, but total carrying cost escalation beyond household income capacity. So what does this mean for different homeowner segments? Homeowners who purchased before 2021 with low fixed rate mortgages and substantial equity remain in strong positions. Nothing in current data indicates broad-based instability for this segment. These homeowners have protection from rate increases through fixed mortgages and equity cushions, protecting against value fluctuations. The appropriate strategy is patience rather than reacting to headlines. Homeowners in more vulnerable positions, particularly those who purchased in 2022 through 2024 in Sunbelt markets using FHA financing with builder incentives, should assess situations carefully. Review all carrying costs, including insurance renewals, property tax bills, HOA reserves if applicable, and ARM adjustment schedules if relevant. If costs are increasing beyond comfortable levels, contact loan servicers before missing payments. Loan modifications and payment deferrals are more accessible when borrowers are current rather than already delinquent. The collapsed FHA cure rates indicate many borrowers wait too long to seek assistance. For potential buyers, current conditions create opportunities not seen in recent years. 36% of builders are reducing prices, with 60% offering incentives. Some builders spend an average 14% of sale price in concessions. Markets including Cape Coral, Austin, Phoenix, Tampa, and Dallas show buyer leverage not present since 2019. Buyers should avoid overpaying, understand exactly what builder buydowns conceal, and obtain independent valuations before signing contracts. For sellers, particularly in Sunbelt markets, inventory is increasing and days on market are extending. The longer sellers wait, the more they compete with individual sellers and institutional investors, reducing portfolios. Pricing ahead of market movements rather than reacting to them improves outcomes. Let me provide perspective on current conditions versus historical patterns. This is not 2008. Lending standards are substantially tighter. Most existing homeowners locked into low fixed rates. Overall delinquency at 3.68% is nowhere near the 10% levels seen in 2010. What we're experiencing is distress concentrated in specific borrower segments, specific loan types, specific geographic markets, and specific purchase vintages rather than broad-based systemic failure. This concentration means many homeowners will experience stable conditions, while others in different circumstances face substantial challenges. The divergence between segments can obscure underlying problems until they affect individual neighborhoods and families. Homeowners who recognize signals early, assess carrying costs honestly, and position appropriately will navigate current conditions more successfully than those who don't monitor their specific situations. The critical factors to monitor include total carrying costs beyond mortgage payments, particularly insurance and special assessments, equity positions, especially for recent purchases in markets showing price adjustments, loan type vulnerabilities, particularly FHA loans and adjusting arms, and geographic concentration in Sunbelt markets showing elevated inventory and institutional investor selling. For homeowners experiencing financial pressure, resources exist. HUD-approved housing counselors provide free assistance to homeowners facing payment difficulties. Many loan servicers offer modification programs, forbearance options, or repayment plans for borrowers experiencing temporary hardship. State and local programs may provide property tax relief, insurance assistance, or other support. Legal aid organizations can provide guidance on foreclosure processes and borrower rights. The key is seeking assistance early rather than waiting until situations become unmanageable. For the broader market, current conditions don't indicate imminent nationwide collapse, but rather ongoing adjustment in specific segments and markets. The institutional investor repositioning, elevated FHA delinquencies, underwater borrowers in specific markets, and insurance cost pressures create challenges for affected homeowners, while the broader market shows relative stability. Understanding which segment you're in and monitoring relevant indicators for that segment is more useful than reacting to national-level headlines that may not reflect your specific situation. That's the breakdown of current foreclosure and delinquency data, what's driving defaults in specific segments, and what it means for different homeowner situations. Thanks for watching. If you found this analysis helpful, let me know in the comments. Tell me which factors are affecting your market, or if you have questions about specific situations. And if you want more content breaking down mortgage market dynamics, housing trends, and market analysis with no sensationalism and no fear-mongering, just data and careful analysis, subscribe to the channel. I'll see you in the next one.